people think it's magical. Oh, I'm just paying every 2 weeks and it's paying off faster. No, you're paying extra money. Yeah. And the question is that extra money better being paid towards the mortgage or put somewhere where you can earn cash on it, right? If someone's a crypto expert, maybe they could do way better there and then pay off a mortgage. But if someone's not, they're taking far too much risk and speculation and putting themselves in harm's way, because if they lose, they still have a loan. We saw other people in 2008 go refinance before that, pull all their equity out, put in the stock market because the 90s, the stock market was going so well. And towards, the middle of the 2005, 2006, the stock market's doing well. But then it really came crashing down 2008, 2009, 2010. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Mortgage madness. I mean, it's like people are really wanting to know, what do they do about mortgages? Interest rates are low. Should they pay them off? Tons of gurus say, oh, you got to do it, or you're enslaved and the banks are crushing you. And what's the best way to do it? So Stoba, I know we got a question on this. Let's dive in.
Yeah, we have a couple of videos where you talk about your opinion on whether to pay off your mortgage or keep it. And there have been some interesting comments to read, but we have a question that Robert wrote in on your YouTube channel and just said, what would be the best method if the solution for him was to pay off his mortgage? So if someone has decided that that's the best strategy for them, what advice would you give them, or what methods could they utilize?
Okay, the first thing we need to look at is something that I would call cost of money. Okay, so cost of money is, what is the best interest rate you can either earn on your money that's sustainable, that's relatively safe, or what's the highest interest rate you're paying on your money? Some people are paying 29% on credit cards. That's a high cost of money. Anytime you don't spend $1 to pay that down, that's $1.29 that's costing you. But what I'm looking at is, what can you earn on your money? And for a lot of people, they don't know what to do with their money, right? So if you're putting your money in a savings account right now, you're making less than 1%. That's really low, and the banks are charging more than that. So I could see why it's frustrating, why you'd want to pay off that loan.
Yeah.
For others, they may learn about something called cash flow banking. Now, cash flow banking might be able to get them 4%. Now, that could be tax favored 4%. In addition to that, that could be after expenses as well. And now if the bank is only going to charge them, let's say 2.5%, well, you'd be paying this off faster if you put money into a cash flow banking policy, which we've done a ton of videos on that, where you're overfunding into a guaranteed insurance contract that gets a minimum interest rate plus dividends. And once it's paid, it's guaranteed. So then you're putting money in your cash flow banking, paying the minimum payment, whether that's interest only or 30-year mortgage on your loan. And then when this money, grows in the cash value, you could pull that out and pay off the mortgage. So for some, that would be the best case. For others, if they are sitting in a savings account, and they're earning less than 1%, right? 1% or less. Well, then what they should do is they should really consider an interest-only loan. And here's why. An interest-only loan, some people use a home equity line of credit. Others just get a 7 or 10 year adjustable rate mortgage where it's fixed for 7 or 10 years before it changes. And by paying interest only, it's not amortized. When you have an amortized loan, you have a fixed payment. And even if you pay that loan down, that payment doesn't go down. The term, or how long it takes to pay it off, shortens. But until it's paid off, your payment still stays fixed. If you're an interest only and you're earning next to nothing and you put money down and you start paying that down faster, it lowers your required payment. So if you keep making the same higher payment, it's going to pay that off faster and it's going to lower the payment. So if you get in a financial crunch or you can't make that higher payment, you now have a lower payment. That's what's great about not having it be amortized. So what we're talking about here is method versus objective. A lot of methods that people try to use is biweekly payments. Now, biweekly payments means that every 2 weeks, you're making a payment. But, months, there's only 1 month that has 28 days in it. Not every year, but that's February.
Yeah.
So that would be, you make 2 payments, it's perfectly even. But some months have 30 days or 31 days. So when you're making a payment every 2 weeks, it's the equivalent of making 1 full extra payment per year. So yes, you will pay your mortgage off faster, assuming that you stay in that house the entire time, you don't refinance and you do that, but it costs you more money to pay that off. So that money's worth something, which goes back to your cost of money. So people think it's magical. Oh, I'm just paying every 2 weeks and it's paying off faster. No, you're paying extra money. Yeah. And the question is that extra money better being paid towards the mortgage or put somewhere where you can earn cash on it, right? If someone's a crypto expert, maybe they could do way better there and then pay off a mortgage. But if someone's not, they're taking far too much risk and speculation and putting themselves in harm's way, because if they lose, they still have a loan. We saw other people in 2008 go refinance before that, pull all their equity out, put it in the stock market because the 90s, the stock market was going so well. And towards, the middle of the 2005, 2006, the stock market's doing well. But then it really came crashing down 2008, 2009, 2010. So we really have to take into consideration risk. And we also have to take into consideration the plan. Because if the plan requires effort and attention and they have to do something about it, it may fall off the rails. If it's automated, it may be helpful. So these are just a couple aspects. A lot of people just go to a 15-year mortgage. They go, hey, I'll pay off my home sooner. I pay less in interest, but they earn less in interest because now their money's tied up. So there's always an interest cost, whether you pay cash and you give up the right to earn interest or whether you finance and you pay the interest. The banks are doing better than most people. They're earning more than most people earn. So this is why for a lot of people, trying to pay more to the bank may be a good idea if it lowers their payment. But if it's amortized, it puts them in a place that if they get in financial trouble, we've seen a lot of people during COVID lose their jobs, businesses go out of business. And now all of a sudden, what if you have a really high payment on a 10-year or 15-year mortgage and you have all this equity in your home? You can't access that equity if you need the money because banks only lend to people who don't need it.
Right. They know what to do. One of my questions is when someone's going to purchase a home is the ability to access an interest-only loan versus an amortized loan dependent upon their credit score, or when someone's going to buy a home, how do they decide if which one's best for them?
Couple factors. Down payment. A lot of times the bigger the loan, the bigger the down payment required to get an interest-only loan. The second thing is a lot of people can get a second HELOC, a home equity line of credit, if there is equity in their home. But the issue is it might not be fixed for very long and it might be variable, and interest rates are really low right now. So they could go up in the future. So that's a risk that you're facing, right? Or they could cut that loan down as you pay it down and you can't get access to that money. Like there's something called a velocity banking or home equity line buy down, where people put all their money, all their bills on a credit card, and then they pay it off with their home equity line of credit. And then they just take all their income and pay down the line of credit throughout the month. So they float the bank's money for 30 days, not paying interest. And then they pay down their own home equity line of credit. Then they pay off the credit cards with the home equity line of credit, therefore shaving off the amount of interest they had to pay that month by paying it down a little bit. But if they cut that back, that could be an issue. So that's one thing you have to take consideration. And if it's not automated, are they the type of person that will pay attention to that frequently enough to make sure that they continue doing that? I know people that have paid their loan off that way, and that's awesome. I know other people that it didn't go so well for them. They just didn't, they ended up putting too much on their credit cards. They couldn't get the access to home equity line of credit. So you have to be careful.
Okay. So one question that I have is calculators. So a lot of times people will go online, find a calculator to know how to determine their payment and when to pay it down and how much more they want to put towards their house. So I'm just wondering, are there any calculators that you recommend? Is that a good idea to trust those online? Because I think it's a pretty specific detail for someone to think I'm paying something twice a month, but then I'm actually paying one more payment a year. Like probably most people are not thinking about that,
they don't think
and what
about
to do with that residual payment that could earn them more money.
Right. Especially if it could pay down a credit card or a student loan that might be a much higher interest rate. This is my issue. People are taking all this money and it's like they automatically put money in a retirement plan, or they automatically take and put more money towards their mortgage, but they might have higher interest rates that they're being charged on credit cards or on a student loan than what this is costing them. So why are we not focused on the economics behind it? So one thing we have to make sure and make a distinction is math versus economics, right? A lot of people think that math and money are the same thing.
They're very different.
Math is useful in understanding money, but they're different because of something called opportunity cost. When we use a dollar, we also have an opportunity cost of what else we could have used that dollar for, kind of like the cost of money conversation.
For sure.
If I spend $1 versus pay down a credit card, it's not just costing me $1, it's costing me $1.29. Or even though there isn't, math may help me calculate the interest cost on a 15-year mortgage versus a 30-year mortgage, but economics helps me understand the opportunity cost of that money. And so here's what I would leave people with is if you could earn 5% or pay 5%, it wouldn't really matter whether you paid off the mortgage, right? Or whether you financed it, other than your peace of mind. And this is where it's important on the individual. Some people just feel elation and freedom and excitement to have that paid off. Other people, it doesn't matter. Like, I have the money to pay off my mortgage right now. Now, where we're sitting, there's no mortgage on this property. But on my other property that I plan on selling in the future, I did end up getting a mortgage on it just because I'm like, well, it's really cheap. I'm doing better in cash flow banking than I'm doing on that. So I'm actually getting a little bit of tax advantage on both sides. I have a little bit more control over my money, a little bit more flexibility. And so I like to have that opportunity available to me, but I understand money and think about it a lot, and I'm in that field. Other people may not want to have that stress. And you know what? It's a personal choice. There's economics and peace of mind. But the economics looks at the bigger picture, not just exactly what we're paying the institution. It's what we're losing when we make these choices.
Yeah. And the reduction of stress, of anxiety, and having peace of mind in your life has a high value.
High value.
It changes your energy. It changes what you spend
your
your time
ability to be productive, your ability to earn more money. It has an economic effect because if I'm constantly in stress and worried and losing sleep and exhausted versus feeling good and like this is taken care of, and now I can make some decisions where I can swing for the fences in my business because it's not going to hurt my family financially. That's a different place to be.
Absolutely. I'm with you on that.
All right. So there's a few insights and ideas. Method versus objective. What do you really want? Why do you want it? And then what is the best method to get there? Pay extra, get an interest only versus an amortized loan, put some in something else that helps grow faster than what it's costing you. It depends on who you are. And I'm not one of those people that wants to dumb this down and say, just pay extra, just get rid of the mortgage, and then you can invest, because you lose the time value of money. You lose the knowledge of what you could do with that. You lose the opportunities that come along the way. And we're all in store for major opportunities right now. It's the greatest transfer of wealth we're ever going to see. But most people are going to be taking these high inflation dollars that are going to have less value in the future to pay off a thing like a mortgage that inflation helps us because it makes the payment feel less and less year by year, simply because of fear and because we're only focused on math and not economics. So hopefully this helps you turn your thoughts into profits and go out there and build a life you love. Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.